Hello, everyone. I hope everyone is doing good and listening me clearly. So please, guys, do let me know. Are you guys listening me clearly? So thank you so much, everyone. Okay, guys, today is day 3 for this practice to pass session for June 2022. And today we are going to solve two questions, and both questions are on analysis. So both of these questions would be on the interpretation and analysis. Analysis is an important topic, and it is a compulsory topic in SBR exam. So you will have a question, maybe 12 maybe for 12 marks, maybe for 15 marks on the analysis area. So you can call it interpretation as well. You can call it analysis. So the topic is interpretation and analysis, guys. I have picked two questions. The one is from recent attempt, which is September and December 2021 attempt. The recent attempt that is available on ACCA Global in past papers section. And the other one is from December 2019. Again, a very important question on this area. So we are going to solve these two questions. First, we will revise the areas that have been tested in these two attempts, and then obviously we will be solving the questions. So these are the questions that we are going to attempt today. So first question would be question 3 from December 2020 exam. And the topic which are being tested here in this question are IFRS 16, in which they asked about lessee accounting. They asked about exceptions to lessee's accounting. And they just tested what would be the impact of these different transactions on different ratios. The ratios are mentioned in the questions, and you have to write it other ratios as well, some other ratios that is being impacted by the above transactions. So there are certain transactions given, and the examiner asked about the impact of these transactions on different ratios. So IFRS 16. The other topic that is being tested here is IFRS 11, in which we need to understand the characteristics of joint venture. Then we need to understand the equity method of accounting. And in equity method of accounting, sometimes we have bargain purchase gain, and we need to recognize that bargain purchase gain. But yes, we have some conditions that we have to fulfill before recognition of bargain purchase gain. So we'll be talking about those conditions as well. So these are the topics for September, December 2020 question 3. So let's understand the basic accounting of lessee, which is required to solve this question. Then we will be talking about some other areas that I will be revising. So let's understand what is lessee's accounting and the information that is required in this question. That is required to solve this question, guys. So let's understand, guys. We have single accounting model. We have single accounting model for lessee's accounting. And that single accounting model is that you need to book a right of use asset. whenever we will enter in a lease contract and we acquired an asset under lease. So as a lessee, we have to recognize the right of use asset. And on the other hand, we have to recognize a lease liability. So this is the accounting model in which we have to recognize the right of use asset as well as lease liability. So if we have a contract to use asset, if we have a contract to use asset, and we have a contract to use that asset for 4 years, for 5 years, so contract term is for 5 years. So we can say that we have right of use, right of use, right to use asset. So if we have a 5 years contract to use the building, so we have a contract. The building is not our asset. Building doesn't belong to us. But as a lessee, we can say that we have right to use this building. So building is an underlying asset, and this underlying asset belongs to lessor. We will say that we will not recognize this building because we are just renting this building. We have just acquired this building to use. We have acquired this building on rent. So we'll say that the building is not an asset, but yes, we have right to use this asset for 5 years. So right in every standard is an asset. It meets the definition of asset given in framework. So we need to recognize the right of use asset. Because in this lease contract, we have a right of use asset, and on the other hand, we have lease liability. What is this lease liability? So if we have contract of 5 years to use this building, now what we need to do, now we have to pay maybe annual installments, maybe semi-annual installments, maybe quarterly installments, maybe monthly installments, but you have to pay. So you have to pay installments, you have to pay installments, and if you have to pay installments, then it means there is a contract liability on you as well. So we need to recognize right of use asset and we need to recognize a lease liability. So the lease liability would be present value of future lease payments, the payments that are unpaid, we need to take the present value of these payments at a relevant discount rate. This relevant discount rate should be interest rate implicit in a lease. If we don't have implicit interest rate in a lease, implicit interest rate in a lease, then what we can do, we can use incremental borrowing rate of lessee. So we can use incremental borrowing rate of lessee. Incremental borrowing rate of lessee. So incremental borrowing rate of lessee will be used when implicit rate will not be given in the question. Otherwise, we will always prefer implicit interest rate in a lease. It will be given. Both rates will be given. If both rates are given, obviously, we will prefer the first one, which is implicit interest rate. On the other hand, we need to book a right of use asset, and the right of use asset will be capitalized at cost, and the cost includes lease liability itself. Any payments, prepayments that we have paid, just like upfront amounts that we are paying to get the asset on lease, or initial deposits, we need to deduct any incentive if we are receiving some incentive from the lessor. And if there is any initial direct cost, that will also be capitalized. And then if there is any present value of dismantling, removing, restoration cost, we need to add this in the right of use asset as well. So we need to book an asset, we need to book a liability. And after that, once we have booked this asset and liability, what we need to do, we will subsequently measure it, means we will measure it at year end or reporting date. We will measure this right of use asset either in IS 16, which is property, plant, and equipment, either in IS 40, depending that what we are doing with this right. If we are using, like if I acquired a building on lease and I'm using that building. So if you are using that asset, obviously under use assets will be classified in IS 16. If you have acquired vehicles on lease and you are using them, then obviously it is an IS 16. But yes, IS 40 is on investment property. Investment property will be applicable if we acquired a property. It is only applicable on property, land or building. So if we acquired a property, on lease and now we let it out, we rent it out. So we give it under lease to another party. We give it under rent to another party. So we are acquiring asset on lease and we are giving it on rent. So if it is a property, then obviously we need to apply IS 40. So subsequent measurement of right of use asset depends what is the use of that asset, depends what is the purpose of that asset. If the purpose is used, then obviously we'll take that asset in IS 16. If the purpose is rental purpose and it's property, it's only property, then obviously we'll take it to IS 40. But what if we acquired a car on lease and we are renting it? We are doing a business of rent and we are renting it to other parties. Then what will happen? Obviously, it will not be counted for under IS 40 because in IS 40, IS 40 only deals with property. If you are acquiring car and you are letting it out, you are renting it out, then obviously it will be under IS 16. Every plant and machinery, either it is being used or it is being given on rent to others, it would be a part of IS 16. Now subsequent measurement depends on the standard. If IS 16 is there, then we have to follow cost and revaluation model. And if there is fair IS 40, then obviously we have to follow cost or fair value model. So these are the models that we need to apply. Usually right of use asset is under cost model. Now what we need to do is, now what will happen? Now we need to depreciate. But before depreciation, we have a question from someone. And the question is, if we lease out a building, what happened? So guys, just do let me know what will happen. Please give an answer of this question. What will happen if I acquired a building on lease? Then obviously we will say that this building is not my asset, but because we are acquiring it on lease, but we will say that this is the right in this building is my asset. Now right of use asset, there is a right of use asset. Now what we need to do, now we are letting it out. So lease out, let it out means rent out. It means we are actually giving it on rent. So what will happen, guys? Obviously, this building right of use asset will become a part of IS 40. It will become a part of IS 40. Is that okay? Now, what we need to do, guys, what we need to do. So now we need to depreciate this asset. We will depreciate it over lease term, or we will depreciate it over lower of lease term or useful life. When we will take lower of lease term or useful life, when we are going to take lower of, when asset will remain with lessee at the end of lease. When asset will remain with lessee at the end of lease. It means there is a clause in the contract that ownership of asset will be transferred to lessee. So if there is a clause, what does it mean? End of lease. What does it mean? Then it means the asset will remain with lessee at the end of lease term. So it means the lessee is going to use this asset over useful life. So usually we took lower of lease term or useful life, and otherwise we will take, if an asset will not remain with lessee at the end of lease, then we will take lower of. Otherwise, if asset will remain with lessee, then we are going to use useful life. There is a mistake in these notes, so useful life. We are going to use useful life. So we are going to use depreciation period, a useful life, if asset will remain with the lessee. It means lessee is going to use for the full life. Initially, asset is being used by the lessee under lease, and after the end of lease, the ownership will be transferred to lessee. And because now the new owner is lessee, and after the lease, asset is still being used by the lessee. So the total useful life is relevant here, and you need to depreciate over useful life. Now, we have another question. I'm going to answer this question in a while. So wait a little, Vida. So now we need to subsequently measure the lease liability as well. What is the subsequent measurement of lease liability? The subsequent measurement of lease liability is that your opening balance will be here, lease liabilities opening balance. It will increase by finance cost. So over the years, you have to pay interest on this lease. So what will happen? Your lease liability will increase by interest every year. So look, if we have a liability of 200 at the rate of 10%, the 10% is interest rate. So we have a liability of 200. So what will happen at the end of year one? Your finance cost will increase your liability. So the 10% will increase our liability. So 10% will increase our liability. So initially, I owe them as a lessee, we owe lesser 200, but now it is a 20 more that we have to pay them. So our total liability is 220. Now we have to pay installment. And what is that installment? So if I'm paying some installment of 50, so this 50 is going to decrease my liability. So my new liability would be exactly 170. So this is my new liability. And this table will be the same for the next year. And obviously, again, it will be carried forward as it is. But the opening balance will change. Now, this opening balance, for year two, opening balance would be 170. So what is the subsequent measurement of lease liability? It will keep increasing by finance cost, and we have to deduct an installment paid from this liability, and it will, the installments paid, the amount paid, any payments to lesser will decrease our liability. So this is the subsequent measurement. There are certain people who make this type of table. Obviously, the answers would be same, but they usually split in installments into interest and principal. So you can do that as well. There are two journal entries. Obviously, finance cost is going to increase my liability. So debit is finance cost that will be charged to P&L, and we are going to increase the liability. And then when we will pay installment, what will happen? Our lease liability will decrease. So this is the basic lessee's accounting. So we have another question from Bida. She's asking, sir, whether you are talking about financial lease or operating lease. So listen carefully. When we will be talking about lessee, we are not going to classify the lease into finance and operating lease. For lessee, there is no classification. No classification required. No classification required. There is no financial or operational lease. So no classification of lease. It is just a lease. We have a right of use asset and we have a lease liability. But when we talk about lesser, if we are doing accounting of lesser, then we can say there are two types of leases. The one is financial lease and the other one is operational lease. So there are two types of leases. The one is financial and the second is operational lease. And the first one is financial lease. So you have to classify the lease from the perspective of lessor rather than lessee. For lessee, there is only one type of lease, there is only one accounting model, and that is that lessee has to book a financial as a lease asset, right of use asset, and lessee has to book a lease liability as well. Now, guys, but yes, we do have, we do have, we do have exceptions. Yes, we need to book an asset liability. Always you need to book an asset. Now, what we need to do is, but yes, there are certain exceptions. There are certain exceptions. There are two exceptions. And in those exceptions, we will not follow this accounting. We will not book a right of use asset. We will not book a lease liability. So there are two exceptions. And what are these exceptions? Let's understand this. We have another question, guys. The question is, can you explain the difference between guaranteed and unguaranteed value? Yes, I will in a while. So recognition exemption is a lessee may elect not to apply the requirement of recognition and measurement of right of use asset, right of use, the lease asset, and a liability. So recognition exemption is that you don't need to book no asset, no right of use asset, and no liability. You don't need to book right of use asset, and you don't need to book a lease liability. So we are not going to book a lease liability or right of use asset. So what we are going to do now, listen carefully, there are two exceptions. These exceptions are not compulsory exceptions. These are optionals. If entity wants to book right of use asset and lease liability, they can do that. But this is not practically possible or cost effective or beneficial for any party. So it's better to apply this exception. What is this exemption? Listen carefully. The first exemption is short-term lease. So if we have a short-term lease, what does it mean? It means lease of 12 months or less. Lease of 12 months or less would be a lease. So if we have entered in a lease contract for 9 months, for 6 months, for 5 months, for 11 months, it would be a short-term lease. But if lease contains a purchase option, then it will not be classified as short-term lease. Then it will not be considered as a short-term lease. So remember, it should not have a purchase option in the lease. If there is a purchase option, then it will be, no exception will be applied. You can't apply the exemption on those types of lease where the lessee has purchase option. And in that situation, you have to book right of use asset. You have to book a lease liability. Now, guys, the second lease is a lease for which the underlying asset is of low value. Low value underlying asset means personal computers, small office furniture, PC, phones, your personal phones. But how you are going to assess whether it is a low value asset or not? You need to assess on the basis of new asset price rather than your asset price. What does it mean? Maybe it is possible that I'm buying a second-hand asset. I'm buying an old asset. So if I'm buying an old asset, which actually cost me very less, like it is just cost me $3,000. Now I just want to qualify this asset as a low value underlying asset. I'm saying that I have entered in a lease contract where the contract is of an asset and that asset has only value of $3,000. But the same new asset in the market is, but the new asset in the market, the new asset cost in the market is 1 lakh. So I'm buying a second hand asset which has deteriorated a lot, which is at its end of its useful life, which has very few benefits left. So I'm buying this for 3,000, but the new asset is for 1 lakh. So the classification of low value underlying asset will depend on the basis of new asset cost rather than your asset cost. So 1 lakh would always be will always be a major value and it will not be classified as a low value underlying asset. Usually you can say up to $5,000 is the low value limit, and this is again a judgmental value. So you can say that my judgment is up to 5,000 is a low value underlying assets, and above 5,000 would be a high value underlying assets. But remember, You need to check the value of new assets rather than your assets. And there is one exception again, that cars cannot be low value underlying asset. Cars cannot be low value underlying asset. So now we need to follow low value underlying asset. Now we need to follow these basic concepts to solve question. First, we will solve the question and then we will take some questions and I'll answer some questions like what is the difference between guaranteed and unguaranteed residual value and some other questions. So let's move towards a question. But before that question, another arrangement is joint venture. But the first part that we are going to solve is related to lease, and we have actually revised sufficient knowledge to solve this part of the question. So this is a question on analysis, guys. So what we need to do, listen carefully. So what are we going to do? So this is exhibit related to a question and the requirement is here, guys. So we are going to solve part A, requirement A. So what is requirement A? Listen carefully, guys. Guys, always divide requirement into sub-requirements, into multiple requirements. There are multiple requirements. So the first task would be you have to divide this. You have to divide this. Okay. You have to divide this into multiple requirements. So let's see what are the requirements available. Explain with suitable calculations. So you need to explain and then you need to give suitable calculations. The impact of three alternative companies car options on earning before interest and tax, depreciation and amortization, which is APTA. We call it often APTA. So there are three alternative options available in the question related to car. Now what we need to do? You need to tell them the impact and you have to calculate as well. You need to give calculation and you need to explain. Earning before interest, tax, depreciation and amortization, the first thing. And the second thing is profit before tax. So the second thing would be profit before tax. And the statement of financial position for 31st December 2000 X7. So year end is 31st December X7 and you have to give the impact. Note, candidates should refer to Ifrs 16 leases where appropriate. So you can refer to leases where appropriate. 13 marks are there, guys. So there is a portion of analysis as well. And these types of questions are very common and these are constantly being asked in SBR exams. So let's understand what is the question. This is the exhibit related to that part of the question. So let's understand, guys. What we need to do is we have to read the information. So guys, I just want everyone to read option one for me and just tell me what should be the answer. What is the accounting treatment for option one? So I'm waiting, guys. We have just revised the IFRS 16. So you have just 2 minutes to read and to interpret and to analyze what should be the answer. What should be the accounting treatment? Okay, so I'm just asking about the accounting treatment. So just 2 minutes, guys. You have just 2 minutes. I'm waiting. Okay, guys, thank you so much for your answers. Thank you so much, everyone. So let's understand what is happening here. So listen carefully. The first transaction is on 1st Jan X7, STEM company is considering providing company cars for its senior management and is comparing three options. So they want to give cars to the senior management and they are considering three options. The first option is the cars can be leased for a period of 4 years starting on 1st Jan 2000 X7. That they will acquire these cars on a 4 years lease. So guys, this is 4 years lease. So option one is 4 years lease. The cars have a total market value of 75,274 on this date. So cars have a value of 75,274. But what will happen as a lessee? You are a lessee here, guys. You need to give cars to the senior management, but you have to buy cars. Now, first, you have to buy cars, you have to take cars on lease, and then you will provide it to the senior management. So this is what actually happening here. Okay. So what is happening here? The cars have a market value of 75,274 on this date, but we don't record this fair value. As a lessee, we record, this is option one, guys. This is option one. As a lessee, we recognize asset at cost and we need to book a lease liability. So it is a 4 years lease. So this is option one, 4 year lease. So let's understand what is given, what is the other information available. So the lessee lease requires payments of 1403 on a monthly basis for a duration of the lease term, of which 235 is a servicing charge. So you have to pay a lease payment every month. This is monthly payment, guys. Every month you have to pay 1435 per month. So you have to pay per month 1403, but out of which 235 is a servicing charge. So it will be a service charge. So actually you need to split. So the true payment for lease would be obviously 1403 minus 235. So my lease payment would be 1403 minus 235, and the servicing charge will be charged to P&L immediately because it is just like a repair expense. STEM company wishes to show the servicing charge as a separate line item in P&L. It will be charged to P&L as an expense. That's it. And it will be an operating expense. This will be a part of operational expense. Now, guys, at the end of 4 years period, there is no option to renew the lease or purchase the cars. So it means you have to charge depreciation on lower of, because the asset will not remain with lessee. So you need to charge depreciation on lower of lease term or useful life. And here is the useful life 4 years. And there is no residual value guaranteed. So no guaranteed residual value is there. The interest to be charged for the year ended 31st December 2000 X5 is correctly calculated at, so the interest has already been calculated. It is given in the question. And he's saying correctly. If he's saying correctly calculated, then there should be no doubt on this interest. So this would be a correct interest. Based on the implicit interest rate in the lease, the net present value of the lease payment over 4 years is 5,803, excluding the service charge. Yes, service charges are not part of, should not be a part of lease liability. So what we need to do is we need to book a right of use asset, guys. And the journal entry, you don't need to give journal entry because it was not required in the question. So you need to book a right of use asset and you need to book a lease liability. And the value should be equal to, the lease liability is given in the question. This is 50,803. And the right of use asset should also be at 50,803. So what is the initial measurement of right of use asset? You book right of use asset at lease liability plus if there is any initial deposit. So there is no initial deposits minus any incentive. There is no incentive received plus you need to add transaction cost, you need to add present value of dismantling, removing registration cost. So other than lease liability, there is no other items for right of use asset. So we'll book right of use asset and we'll book lease liability. Now what we need to do in subsequently, we need to depreciate. And this is something that you need to write. You need to write in a single line that we, in this contract, we will book a right of use asset and lease liability of 50,803. This is your first line in the answer. That we will book, we will recognize, we will book asset and lease on 1st Jan 2007. You can mention the date as well. Now, after recognition, you need to charge depreciation. You need to charge depreciation. And the depreciation will be charged, obviously, over 4 years. There is no residual value. There is nothing else. So we need to charge depreciation. So what will be the value of depreciation, guys? So what will be the annual depreciation? So what do you think, guys? What would be the annual depreciation? Thank you so much, everyone. It is actually is it okay? Fair enough. Now, guys, what is next? So what is next? So what would be the depreciation, guys? The depreciation would be 12,700.71. So we'll write it 12,701. We will round it off to this amount. So the annual depreciation will be 12,701, guys. So this would be the depreciation. Now we need to book the lease liabilities. We need to subsequently write lease liability as well. We know lease liability will increase by finance cost. So the opening balance of lease is 50803. It will increase by finance cost, and the finance cost is given by the finance cost is given. So look, what is the finance cost? They have correctly calculated it 2274. So your liability will increase by 2274. So you need to write this finance cost, and then you have to deduct payment for lease, not payment for service. Payment for service is a separate expense to payment for service. So you need to write payment for service. So what is payment for service now? Sorry, payment for lease. This is not payment for service. This is payment for lease. Payment for service will be a separate line item in P&L. It will be charged as an expense. So payment for lease, guys. So what is the payment for lease? You need to understand. So the total payment that we are actually doing is 1403. But out of this 1403, 235 is the servicing charge. So we need to deduct that. And now we need to multiply this with 12 because there is a monthly payment and you are paying on a monthly basis. So there we need to multiply it with 12. So it will give me 14,016. 14,016. Now the closing balance would be, what would be closing balance, guys? So just tell me the closing balance. What would be the lease liability closing balance? We need to add, we need to deduct. Thank you so much. This liability would be 39,061. So this would be your lease liability, guys. So we have right of use asset and we have lease liability. This is our lease liability. Now we need to book a right of use asset. We have already did the accounting. Right of use asset was 50,803. Now we need to deduct depreciation, which is 12,701. We need to deduct depreciation, and now we have, just wait. Now we have 30. What would be the value of asset, guys? So I need a value of asset as well. It is, according to someone, it is 38,102. So this is value of right of use asset. Now you need to book an expense, servicing expense. So servicing expense, guys. So now I need to make a P&L. So we need to make a service expense. What would be service expense, guys? So 235 a month, 235 a month, multiply by 12. So we need to book a 12 months expense, and the expense is 2820. So this is option 1. Now I have some questions which is from Nazish. The student is asking, sir, what is the treatment of prepaid rentals under IFRS 16? So if you're talking about from the perspective of lessee, then we will add prepayments to this right of use asset. Any prepayment will be a part of this asset, this right of use asset. And it will not be a part of lease liability because you have already paid it. So it will be a part of right of use asset. Okay. Now, guys, this is first option, but actually you need to tell them this is first option accounting, but you need to tell them what is this is just a calculation along with explanation. You need to write this as well. So what we need to do now is that you have to tell the impact of this transaction on profit before tax. You have to tell them the impact of these things on APTA, which is earning before interest and tax, and statement of financial position. So remember that part as well. But before that, just first solve option 2, and then we will be solving the other part as well. So what is part 2? So what is option 2? Now listen carefully, guys. What is option 2? Option 2, the cars can be purchased for 75. We are on option 2, guys, now. So option 2. The cars can be purchased for 75,272, 274 with a 100% bank loan. With a 100% bank loan, it means you will buy the car by acquiring a bank loan. So the cars would be purchased on 1st Jan X7 and held for 4 years. So useful life is 4 years. Useful life is 4 years. The estimated residual value is already there. So we need to charge depreciation. And we will use this for depreciation. Monthly service cost would still be 235 per month. So if we will buy the cars, we have to incur this service cost. If we will acquire this asset on lease, then still we have to pay a 235 service charge. This is an operational expense, and that's it. The loan would be repayable in 4 equal annual installments commencing on 1st Jan 2000 X9. My year end is 31st December X7, and the installments will start from the next year. Installments will start from the next year. Payments will start from the next year, and assume the average annual percentage rate on loan is 5%. So what we need to do is, guys, it is very simple. We need to book cars here. So what is option 2? But purchase of cars through loan. Purchase through loan. So we need to book cars and the car's cost will cost us 75,274. So the cost of cars would be 75,274. Now we just need to charge depreciation. So you need, if the question is silent, you need to charge depreciation on straight line basis. But other relevant information, they are saying that we need to follow straight line depreciation charge over 4 years. So what we need to do, we need to charge depreciation by using 75,274 minus residual value. Here we need to deduct residual value as well, 753, and divided by 4 years. So what would be the depreciation, guys? Okay, Mr. Osmani, just wait for 2 minutes. I'll explain why we have deducted this 235. Okay, just wait. So guys, what is depreciation here? The amount of depreciation here is 11,380. 11,380. And if we deduct this depreciation, we will get carrying value of asset. And the amount of carrying value would be, I just need a carrying value, guys. I need carrying value. On the other hand, this is 11, this is 63, thank you, 63893. So this is my carrying value, guys. Now again, I need to charge service expense in P&L. Service cost is still same, and that is 235 into 12, and it will be 2820. So it will be 2820, guys. What is next now? You have to book an interest expense on a loan. The loan amount would be same. So interest on loan would be interest on loan would be 75,274 into 5%. So guys, what is the interest on loan? So it is 3763, 3763. So this is option 2, guys. Now we need to move towards option 3. So let's understand what is option 3. Option 3 is a final alternative is to lease the cars with 12 months agreement on 1st Jan X7 with no purchase option. If there would be no purchase option, then up to 12 months leases will be a short-term lease. We know this is an exception. So it is a short-term lease. It is the short-term lease. The cost would be 1,900 per month. The cost would be 1,900 per month in advance, including service charges. So it also includes service charges. But what we are going to do, STEM company would take advantage of short-term lease exemption under IFRS 16. We know that there is an exemption available, and they want to take advantage of that exemption. It means they want to apply that exemption. Why this is written in the question? Because company has choices. If they want to apply exemption, they can. If they don't want to apply exemption, then it's totally up to them whether they want to apply exemption or not. Okay. So what we need to do is we will apply the short-term exemption, and the short-term exemptions accounting is that just charge expense, all installments will be charged as a rental expense on a straight line basis. Rent expense on straight line basis. So every payment that you are paying should be charged to P&L as on a straight line basis as a rental expense, and that's it. Rental expense means operating expense. So here we need to charge rental expense of how much? 1,900 is monthly installment. There is no need to separate the servicing charge. All expense is rental expense. So 1900 into 12, guys. So what would be the expense? It is, according to one of my friend, is 22800. 22800. So this is rent expense, no assets, no liabilities. This is option 3. So under option 3, no asset, no liability. So this is option 3. So rent expense, no asset, no liability, no assets, no liability. Now I'm going to give answers related to this option 1, option 2, and option 3. So if I have missed your question, so please copy and paste it again so that I can watch the questions again and I can answer the question. So G, boys and girls, please do let me know what are your questions. So please copy and paste them again. Please ask them again. How to explain effect on EBITA? Only explain or with calculation. So I'm going to answer this, Nazish. So we haven't solved what is the impact of these things on EBITA, what is the impact of these things on PBT, what is the impact on SOFT. So we will be talking about that. But till now, I'm just asking what if there is any question regarding this accounting treatment, regarding this or regarding this, you can ask the question. So you have to wait a little bit. So the other question is, can you please explain the difference between guaranteed and unguaranteed? Sadhya, again, this is not relevant here. So please, you have to wait again. So any question, guys, related to option 1, option 2, and option 3, please. The first question is, why do we deduct the servicing charge from lease payments? So the question is, why do we deduct servicing charge from the lease payment? The student is asking why you are deducting this 235. So I have to explain this now. Why I am deducting this 235, guys, this. So listen carefully, Mr. Shayan. So I have to write it here. So listen carefully, guys. When you are a lessee, listen carefully. Maybe this would be a next question in your exam, okay? So I have to explain now. So lessee accounting. When you're doing lessee accounting, maybe you will see that in a contract there is a certain lease portion, lease component means lease contract, and there would be another non-lease component as well. So usually in a lease you may have a non-lease contract or component in that contract, or obviously if you are lessee, obviously you will have lease contract as well, lease component or lease contract. Now listen carefully, guys. Now listen carefully. So there would be some non-lease component along with the lease contract. So this is the perfect example that lessor is saying that you have to pay installments. You have to pay installment. And we asked how much installment, and they said that you have to pay 1403. 1403. So we have to pay total installment 1403 per month. But this is not entirely for lease. On the other hand, we are saying to lessor that you have to service our cars. You have to provide us a servicing charge. What does it mean? It means if there is any repairs, if there is any work related to car, we will send it to lessor and lessor will fix the problem. Lessor will repair the problem and then he will return us a car. And maybe there are certain checkups after every month, maybe after 2 months, where they inspect the car, and if there is any problems, they service it. So we are actually taking two services, or we are actually entering into two contracts. The first contract is lease contract, and the other is we are taking service, we are taking service or repair services. So we are taking services, repair services, you can say repair services. So if you're taking repair services, this is simple. This is simply your operational expense, and that's it. It should not be a part of lease. And in the question it was mentioned, Mr. Shayan, in the question it was mentioned that 1403 is the total payment. And it was mentioned in the question that out of this total payment, 235 was for service. So I have to deduct this. So this was the simple answer of your question, but actually I'm revising some topic. And what is this topic? Listen carefully now. So now you have to deduct this because you have to book an expense of service in P&L. This is your expense, and any payment, and the remaining payment is installment paid, and it will be a payment towards a liability. So you need to split your payment into two components. This is payment for lease liability, the remaining amount, whatever is the remaining amount. Okay. So now the most important part is that lessee has option. So this is important part, guys, that lessee has option. That lessee has option. If lessee does not want to split this transaction into two components, lessee does not want that we should charge this 235 as a separate expense. They want to treat it as a part of lease contract. They don't want to split non-lease components, non-lease contracts from the lease contracts. So lessee has option. They can do this. They can treat this as a single contract. It means just forget about the service charge. The total payment would be 403. You need to calculate your lease liability with 403. You need to book an asset with 403, and every total installment will be towards a lease. It will be considered a payment for lease. So this is something that is important. But this option is not available for lessor. Lessor have to split a non-lease components, a non-lease services, a non-lease things from a lease contract. So they have to split, but lessee has option. That's why, that's why, that's why it was written in the question. What was written in the question? Look, it was written in the question that lessee, look, STEM company wishes to show the servicing charge as a separate line item in P&L. What does it mean? It means they have option. If they want to treat it as a single contract, they can do that. But in the question, they mention that they don't want this. They don't want to treat them combined. They want to treat them separate. So this is another reason that why we are deducting 235 from 1403 installment. I hope everyone is clear about this option. Why we are not talking about in the question that this is the option available, because he has already mentioned in the question, the examiner has already mentioned that they want to show it separate. So there is no need to talk about this. So we need to talk about the things that the examiner is asking. If an examiner is saying that they want to do this, then it's okay. So I hope everyone is clear. Okay, guys. Now, so guys, till now, what we have solved yet? Okay, we have to explain what is the accounting treatment. We will explain it, guys. Okay, so what is the first thing? You need to explain with suitable calculations. the impact of three alternative car options. We just calculated the impact. We just give the suitable calculations and we have explained. But the third part of this was impact on earning before tax, interest, tax, depreciation and amortization, profit before tax, and statement of financial position for the year end. Now we have to provide this impact as well. So what we are going to do, we are going to read the further question and let's see what is in the question, guys. So listen carefully. What is in other information? Look, the profit before tax and before tax, the profit before tax and before accounting for any of three options for cars is likely to be 1 lakh for the year ended 31st December 2007. So this profit is given, guys. We have profit before tax and before these accounting treatments. STEM company depreciate cars over 4 years. We have already dealt these transactions. Now we need to give the impact. So I'm going to calculate the impact right now. So let's understand what would be the impact, guys. So I'm going to calculate this impact here. Okay. So what we are going to do now. So they are asking us to give impact. So now we are going to give calculation. So we are saying option 1, we are saying option 2, and then we will explain this. So this is option A. Then we have option B or maybe option 2, and we have option 3. So we have 3 options, guys. Yes. So this is option 1. This is option 1. This is option 2. And this is option 3. So these are 3 options. We have been provided a profit before tax. A profit before tax is given. Profit before accounting of these transactions. So obviously in option 1, it would be 100,000. In option 2, it would be 100,000. So actually the profit is 100,000. Now you need to give the impact of every transaction on this PBT. So now, guys, is there any expense that we need to charge here? Yes. In option 1, we have service cost. Guys, we have service cost. Then we have some operating expense, rental expense, operating or rental expense. So we know in option 1, we have service cost of 2820. 2820. I think so it was 2820. So this will decrease your profit in option 1. So we are just talking about option 1, guys. So just focus on option 1. There was no other expense. So this will give you earnings before interest, tax, depreciation and amortization. Before interest, tax, depreciation and amortization. So what would be the profit, guys? Yes, you are right. It would be 97,180. This is the EBITDA. Now you need to deduct depreciation. Now you need to deduct interest expense. So we have already calculated this. So let's see what is depreciation expense and what is interest expense. So let's understand what is the depreciation expense, guys, in option 1. What is the rent expense in option 1? Depreciation expense was this. This was the depreciation expense and this was the finance cost. So we need to charge this depreciation and this finance cost to P&L. So the depreciation was 12,701 and the interest was 2274. So you need to deduct this and it will be a profit before tax. So what would be profit before tax, guys? So profit before tax was given in the question. Now what I'm going to do is I'm going to deduct all my expenses in option 1 from this profit and we have PBT. And this PBT is 82,000 205. So this is my PBT. Okay. Now we have to take option 2. In option 2, there was service cost. So we need to deduct service cost. There was no rent expense. We have earning before interest and tax and depreciation. It will be 97180. Yes, there was a depreciation and the depreciation was 11,380. Let me check. Look, guys, this was the depreciation in option 2, and this was the interest expense, and this was service cost. So look, we have to charge interest as well, which is 3763. So we have, what is the PBT? What is profit before tax, guys? So it is 82037. So this is 82037. Now what is next now? What is next now? In option 3, we know we have only rent expense. And what was that rent expense, guys? The rent expense was, look, 22,800. No asset, no liabilities. So 22,800 was the rent expense. So now we have APTA, which is 77,200, which is 77,200. No depreciations, no interest, no loans, no assets. So your profit before tax would be 77,200. So this is your profit before tax. So this is how you are going to calculate the impact on APTA. So now just tell me, guys, under which option APTA is better? Under which option APTA is the highest APTA? So this is not. So please tell me. Now I need option 2, 1 and 2, highest APTA, the same APTA, but in under option 3, what do you mean by APTA? There is a question, what do you mean by APTA? I'm actually trying to call this APTA, this amount as APTA. I'm calling this as APTA. So actually, I'm asking you to give me the impact on earning before interest, tax, depreciation, and amortization. No, it's okay. It's completely okay. You should ask. Okay, so what the most so where the impact is minimal, guys, obviously on earning before interest, tax, depreciation, and amortization, under option 1 and 2, the impact would be minimal. But under option 3, the impact would be highest, and it will reduce your earning before interest, tax, depreciation, and amortization to 77,200. So now, guys, what is the impact on statement of financial position? So actually, he has asked us to give the impact on SOFP. So under option 1, what we are going to write in SOFP, and under in option 3, what we are going to write in. So listen carefully, guys. Now, so guys, we have already prepared the balance sheets. You just need to pick the values right now. So what are the values, guys? Look, this is your right of use asset. This is your lease liability. This is your right of use asset. So your right of use asset and your lease liability. You need to book this right of use asset and this lease liability. Under option 2, you need to put this asset and this loan. The loan amount was under option 2. Then you need to write the loan amount 75274 plus interest loan, because the installments will start from the next year. So this is your loan. Under option 3, no assets, no liability. Is that okay, guys? Is that okay? Okay, someone asked me, do we need to give a split of non-current and current? No, you don't need to give it. You just need to write it that the liability will be splitted into, will be divided into long-term and short-term liability, and that's it. Because you can't do it. Why? But the payments are on a monthly basis, and you have to make 12 months table to calculate the long-term and short-term. So this is not possible. So it is better not to do so. Okay. Okay, guys. So we are moving again towards the requirement. So listen carefully. What was the requirement? This was the requirement, guys. These were the requirements. Please look. So we have answered each and every requirement. So I think we are good to go. So what was the last part I have said in, there is a question, what was the last part that I have just said in option 2? I just told that what would be the lease liability? What would be your loan? What would be your loan? Your loan was initially this amount, 75 to 72, but you did not pay interest in current year because the loan will be repayable on 4 annual installments, and the installments are going to commence it. They are going to start on 1st Jan 2008. So initially your loan was your liability, but now the interest at 5% is also due. So the total liability will increase. So the total liability is this amount. Is that okay? Okay, someone is asking me, do we have to mention that which one is favorable? Just like option 2 is being more favorable. So you can say that, but actually examiner didn't ask you about the about which one is favorable. But yes, you can say that because it will take just one line. Yes, you should say that. But in option 2, but you can't say the option 2 is a feasible option because we have PBT 82,037, and here we have PBT. So we have higher PBT, same earning before interest and tax. We have same earning before tax, but PBT is less, like by around by 180 something. Yes, Sadia. You are right. It should be, you just need to mention that liability will be splitted into long-term and short-term liability. You don't need to calculate this because it is difficult to calculate here because actually payments are on a monthly basis. So you need to make 12 months payment schedule to calculate the lease liability, to calculate the short-term and long-term lease liability, which is not possible here. Okay. So can you please confirm again the option 2, we need to write sum of lease liability and interest paid in SOFP? No, no. There is no option. There is no lease liability. We are actually purchasing this asset by 100% bank loan. We are taking bank loan, boy. So actually this was a bank loan. This was not a lease liability. This was a bank loan. Is that okay, guys? Okay, thank you so much. So now we are moving towards the other part. But before the other part, if there is any question other than guaranteed and unguaranteed residual value, other than that, if you have any question, then you can write the question. Otherwise, just write okay, and we are moving towards the next part. Okay, brilliant. Now, guys, we have another part. So what is this part? Listen carefully. Okay, first we are going to revise and then we will be solving this. Look, there is a part B in the question for 5 marks, for 4 marks. And in part B, if the examiner is mentioning that you don't need to refer to any exhibit to answer this part, it is the theoretical part that we need to answer. So examiner is giving a note that there is no need to refer to any exhibit when answering part B. There is no need to refer to any exhibit when answering part B. 1. Now, guys, what is this part? We will be solving this part as well. But other than that, we have again a requirement for 8 marks. So let's see what is this requirement. Discuss why STEM's company's investment in Infosys company should be classified as a joint venture. Why it should be classified as a joint venture? So examiner is asking, I have classified it as a joint venture. I'm saying why it should be considered as a joint venture. So you need to tell them why it is a joint venture. And how STEM company should account for its interest on 1st Jan X7 in accordance with IS 28 investment in associates and joint ventures. So guys, what you need to do is candidate should show any relevant entries. You need to give the entries. So this is the note. If they are asking about an entry, you have to mention an entry now required in the accounting records of STEM company. So guys, we need to divide this into sub requirements. So listen carefully. Discuss why STEM companies investment in Infosys should be classified as joint venture. This is first requirement. That why it is a joint venture. This is first requirement. We need to answer. Second requirement, how STEM companies should account for the interest on 1st Jan according to, okay, so the second is accounting at 1st Jan 2000X7. They are asking about accounting on 1st Jan X7. And the third requirement is you need to mention the journal entry as well. So these are the 3 requirements that we need to answer. Okay. Guys, examiner's answer is extensive. You can't write the same answer. So you just need to reproduce 60 to 70% of that answer. And by writing 60 to 70%, you can easily get 80% marks, 70% marks, 60% marks. So please don't get confused by the examiner's answer. Just read them for learning purpose. Otherwise, you just need to tell them points and that's it. So we are going to make our own answer in this part, and let's see what we are going to do. So we have divided our requirement into 3 sub requirements. So listen carefully now, what is the part? So listen carefully. But first we need to revise joint ventures, guys. So here is the slide for joint venture revision. So let's understand what is happening here. Sir, joint venture, IFRS 11 is the standard which deals with joint venture. It is the standard about joint arrangements. Joint arrangement is the arrangement where two or more parties have joint control over assets, two or more parties have joint control over entities, organization, over company, or two or more parties have joint control over an operation. So if two friends buy a car, they are the joint owner of that car and they are controlling them jointly. It is just a joint arrangement. Two construction companies are doing a project together, and in that project, they have joint control. They make unanimous decisions. Unanimous decisions means they make decisions, they take common decisions, they make decisions combinedly. So unanimous decisions. So the joint arrangements have some characteristics. There must be a contractual agreement of joint control. There must be a contractual arrangement. And we know contract could be an orally we can have a contract as well. So contract could be in the form of written contract and it could be a oral contract. But there must be a arrangement that we are going to control, we are going to have a common control over the entity, operation, or an asset. Now you need to split this joint arrangement into joint operation and joint venture. So actually, whenever there is a joint arrangement, you need to split into joint operation and you need to split it to a joint venture. So you need to decide whether it's a joint operation or whether it's a joint venture. But the most important thing in this question is the examiner is asking why this should be classified as joint venture. It means you don't need to write about joint operation. You don't need to write it about the joint operation. So we need to write this portion of the standard, this portion of the standard, which is joint venture. So this is how we actually pick the relevant topic from the standard and we are going to reproduce this. So we need to reproduce this part of the standard, guys. So what is this part? So listen carefully. So if there is a separate vehicle, separate entity established, if the joint operation, if the joint assets are being managed, joint entities are being managed, joint operations are being managed through a separate entity, it means they have established a separate company. Usually we will say that it's a joint venture. If there is no separate vehicle, separate entity registered, it's just an asset, it's just an operation, there is no separate company established, then we will say it's a joint operation. Now, in joint venture, because you have created a separate entity, what does it mean? So let me explain through an example. Suppose Mr. A and Mr. B or A Limited and B Limited, they want to do a combined project. They want to do combined projects, they want to do business, and they need expertise of each other. So A Limited need expertise of B Limited, B need expertise of A Limited, or Mr. A and B. So there are two entities, they want to do business combined. So what they can do it by their own organization. So A Limited is producing something, he's sending it to B, B is again working on that product, and they combine, they are making some goods and they are selling it, and they share the revenue. Look, they are doing their business through their own organization, through their own entities. There is no separate entity established. There is no separate entity established. So whenever this is the situation, we will say it is a joint operation because there is no separate entity established. But other way to do the business together is that A and B will make another company with the name C Limited. So we will say that C Limited is a separate vehicle, C Limited is a separate entity, and through this entity, they are going to produce a product and they will sell it in the market. So this is a separate entity. Now listen carefully. So there are certain features of joint venture. If you have separate entity, we know the assets of C Limited belongs to C Limited because we know that this entity would be a separate legal entity. This would be a separate legal entity. So an entity, a company is an artificial legal entity. So if there is any asset, the ownership of those assets belongs to this C Limited. C Limited is joint arrangement. So this is joint arrangement. So the first step in joint venture is assets, rights, and ownerships, and the obligation, even if they have certain obligations, they belong to C Limited. So the liabilities of C Limited are not a liability of A and B. A and B Limited are not bound to pay the liabilities of C Limited. Legally, they are separate. So assets, rights, and ownerships and obligations are in the name of joint venture itself. Joint venture itself means C Limited. Then guys, what is next? What is next? The next is what actually will get A and B. These are the parties involved in joint arrangements. These are the parties in joint arrangement. Parties in joint arrangement. So what they will get from this arrangement? Obviously, this is the company. The net assets, share of net assets means assets less liabilities means equity. They have a share in equity means net asset. And this company will earn a profit, and the share of profit will belongs to A and B as profits belongs to owners. So the net assets and profits are shared between the parties involved. And we know what are the parties involved in my example, A and B. So these parties we call these parties a joint venturer. We call these parties a joint venturer. And here joint operators. Here the parties involved will call joint operators. Now what is the accounting, guys? Listen carefully. So accounting is very similar. Joint venture has a similar accounting as associate. So what we are going to do, we are going to apply the equity method to the joint ventures as well. So actually we need to apply IS 28 associate accounting to these joint ventures. So this is the accounting, guys. Now, what is next? So the next thing is, what is the accounting of joint operation? Joint operations are dealt as, look, it will be joint operation if there is no separate vehicle. It will be a joint operation. But if assets ownership, liabilities, obligation doesn't belong to venture itself, they still belongs to the parties involved, then obviously it will be a joint operation. In joint operation, we do accounting which we call it proportionated accounting. Proportionated accounting means if we are 30%, we have 30% share in assets, 40% share in asset. What we are going to do, we will pick our income share, we will pick our asset share, we will pick our liabilities share out of that joint operation, and we will pick our expenses share. And we will add line by line them. We will consolidate line by line. What does it mean? It means if a company is, it means if an entity is there, joint operation is there, they have some property, plant and equipment, they have some intangible assets, they have some inventory, they have some liabilities. What we are going to do, if we have 30% of these assets and liabilities, we are going to pick 30% of this PP and we will add in our property, plant and equipment. We will take 30% of intangible asset and we will add in intangible assets. We will pick 30% of inventory. We'll pick 30% of liability. In the same way, we'll pick our percentage of income and expenses, and we will combine them in our statement of comprehensive income. So guys, in recent attempts, the examiner is asking joint ventures. Now you should focus on joint operation. This is how you need to prepare the standards. Okay, if the examiner has asked lessees accounting uh, in the recent attempts, then you should be focusing on lessees accounting. You should be focusing on sale and lease back transactions, and you should expect that these things will again appear in the exam. So now, what is the accounting, guys, of this joint venture? We know equity method, so we need to recognize it at cost very first day. And if there is any bargain purchase gain, we need to add this bargain purchase gain. So there was a debate in WhatsApp group going on. People were asking about bargain purchase gain as well. So we are going to deal with this bargain purchase gain in two questions now. So we need to add cost plus share of post-tax profits or an OCI. We have already talked about these items in yesterday's session, in the previous session. Now we need to deduct impairment loss if there is any. Then we have bargain purchase gain. We need to add, and if there is any unrealized profit, we need to deduct. And if there is any dividend received, we need to deduct. Unrealized profit will be only parent share. It will be only investor share, only percentage of investor. So only percentage of investor. So guys, let's apply this accounting, and then we'll see if we are not comfortable, we'll make some more examples. So I have picked one past paper question, a separate past paper question, and the source is BPP exam kit. The source is BPP exam kit. So first we will solve this, and then we will moving towards the past paper question. So what is this question, guys? Listen carefully. Yes, we do consolidate. And how do we consolidate? We'll pick our own share. That's it. Okay. So I'm going to revise that part as well in today's class. Okay. So we'll just wait. Now, guys. So first focus on joint venture. As we know that joint ventures accounting is same as associate. The other way to set the exam is that if the joint venture is being asked in question 3 or 4. So look, in recent attempts, it is being asked in question 3 or 4. Then it means in the next attempt, it is going to be asked in question 1. So in this question, it is carrying around 8 to 12 marks. And in next attempt, it will only carry 3 to 5 marks. So they are going to short it for some marks. So this is another way. So you can't ignore simply joint ventures by saying that it has recently been asked. So it means the examiner is going to ask about joint ventures, a joint operation. It will not be the case always. So you need to revise these areas as well. Okay. So now, guys, we need to apply accounting, and I'm going to solve this question. And this is a question on associate, but the joint venture accounting will be same. So let's see, guys, what is this question? The question name is Lee. It is from the past paper, but I picked it from BPP exam kit. So let's see, guys. Lee acquired, we need to do the accounting, guys. Lee acquired 30% of the ordinary share capital of Handy, a public limited company, on 1st April X6. So 1st April X6 is the date of acquisition for 30%. Uh, for 30%, we can say that this companies are associate. We can say that it seems that this company is an associate. The purchase consideration was 1 million ordinary shares of Lee, which had a market value of 2.5 per share at the date, and the fair value of net assets of Handy were 9 million. So the net assets are also already given. So we have fair value of net assets, and we should use fair value of net assets rather than carrying value of net assets. So what is the consideration, guys? We know 2.5, 1 million shares. We have provided 1 million share, and each share has a market value of 2.5. The retained earnings of Handy were 4 million and other reserves of Handy were 3 million at that date. Lee appointed 2 directors to the board of Handy, and it intends to hold the investment for a significant period of time. Lee exerts significant influence over Handy, so we know that this company is an associate. Now, guys, there is a way to write about the standard. So there is no need to write about how we can get the significant influence of the company, because examiner is mentioning himself, is already mentioning in the question that Lee exerts significant influence over Handy. So you don't need to write that how we can assess that the significant influence exists over there. So you cannot write this. So if something is given in the question that he's saying that we have significant influence, so don't write about significant influence. Okay, so just write about the other problems that are available in the question. And right now the problem is we need to do the accounting. So the summarized statement of finance we have acquired on 1st April X6. The summarized financial statement of Handy at 31st May X7 means after 1 year is as follows. Share capital is given, share premium is given, and we have retained earnings as well. Now listen carefully. Share capital, there had been no new issue of shares by Handy since the acquisition by Lee. So no share capital, no new shares are being issued, and the estimated recoverable amount of net assets of Handy was 11 million. So recoverable value is given. It means we have to apply impairment test. Whenever there is an impairment loss given, we need to apply an impairment test. So we have to apply an impairment test. We have to apply impairment test. So what we need to do is, look, what is the accounting, guys? First thing that we need to do is we need to book a investment at cost. Under equity method, we need to book an investment at cost. So what is the cost, guys? So we know we have offered them 1 million share, and one share has a market value of 2.5. So it means our investment, our cost of investment is 2.5 million. So this is my cost. Now what we need to do, we need to add share of post-tax, but there is one thing that you need to calculate always, and that is you need to calculate it always. Before taking share of post-tax profit, you need to calculate goodwill of associate or joint venture. Share of post-tax. So listen carefully, guys. Share of post-tax reserves, share of post-tax profit, share of post-tax other reserves. So reserves. But before that, we need to calculate goodwill. So what we need to do, we need to calculate goodwill of associate. So you have to calculate it all the time in SPR whenever there is an associate or joint venture. Whenever there is a joint venture or associate, you need to calculate goodwill. So what is the consideration, guys, that you are paying for 30% of this company? So we are paying consideration for 30% of business, and the consideration means our cost is 2.5 million. Now you need to take net assets, fair value of net assets, fair value, you need to take fair value, net assets, fair value, and the fair value of net asset is 9. At the date of acquisition, it was 9. And we have acquired 30%. We have acquired 30% of it. So what we need to do, the net asset share is 2.7. If the net asset share is 2.7, then it means we have bargain purchase gain. You can call it bargain purchase. You can call it bargain purchase gain. You can call it income. So we have bargain purchase gain. If this is negative, we have bargain purchase gain. And if this is positive, we have goodwill. So if there is a goodwill in associate, you need to ignore it. You don't need to write it separately because it has already been a part of this cost 2.5. So you have to ignore it. If there is a goodwill, you ignore it. But if there is a bargain purchase gain, what you need to do is you have to add bargain purchase gain of 0.2. Sorry, this is share of post tax. So what you need to do is you have to add bargain purchase gain. You need to add here. So you need to add bargain purchase gain, and the amount of bargain purchase gain is 0.2. And now you can do whatever you want to do, but the most important thing is whenever there is an investment in joint venture or associate, you need to calculate goodwill. If there is a bargain purchase gain, this will increase your investment, and if there is a goodwill, you need to ignore it. And the journal entry to record this would be that you need to increase your investment in associate or in joint venture. Obviously, if we are talking about associate, there could be a joint venture, and you need to credit P&L retained earnings. Ultimately, P&L will be shifted to retained earnings by 0.2 and 0.2. So this is how you need to record this. Now, what is next, guys? The next is we have net assets year end, net assets 10 million. At acquisition, they were 9 million. Now they are 10 million. It means total post acquisition is 1. So post acquisition net assets are 1. So what we need to do, we should take 1 post ac net assets. The increase in net assets during post acquisition period is 1. We should take our own share in associate, which is 30%. So we will add this 0.3 here. Now, guys, if we are taking this, so this is 0.3. So we need to add this. This will give you a carrying value in associate. So this is a carrying value in associate. So we have carrying value in associate, and the carrying value is exactly 3. Now you need to apply an impairment test. So we have recoverable value in recoverable value. So the recoverable value is given, but the recoverable value of entire company is given. Net assets of handy means the whole company. So the recoverable value of net assets of handy was given 11 million, but you don't have all the shares of this company, you just have 30% of this company. So what you need to do, you have to take recoverable value of 30%. So guys, recoverable value is more than carrying value. So we have a gain situation, and as per IAS 36, we should not, as per IAS 36, we should not book a gain here because we have to book a gain. This is the concept. This is an application of prudence concept, which says that you can book the loss, but you cannot book the gain. So there is no need to book the gain. So it means this recoverable value has no implication on our working. So our value will remain 3. But if this value would have been 2.9, then we need to book a 0.1 loss, and the new revised value would be 2.9. So this is how you are going to do investment in associates. So this was a good question on associates. Same question could be asked for joint venture, where we would have a bargain purchase gain. So you need to calculate bargain purchase gain or goodwill in associate as well. If there is a goodwill, someone is saying that I'm confused because according to his or her knowledge, goodwill should be calculated only for subsidiary. Yes, you are right. Actually, Muna, you are right. Goodwill should be calculated only for subsidiary and it should be presented only for subsidiary. Look, if we have goodwill for associate, we are going to ignore this. We are not going to write it separately on the statement of financial position. Why we are calculating goodwill? To understand whether there is a bargain purchase gain or not. If there is a bargain purchase gain, then we will record, otherwise we will just ignore the goodwill. So you are calculating goodwill for associate to, you are calculating goodwill for associate to understand whether there is the bargain purchase gain or not. In other words, you can say that we are calculating goodwill working, we are making goodwill working to calculate bargain purchase gain. If there is a bargain purchase gain, we will add, and if there is no bargain purchase gain, then we will ignore it. Simply, we are going to ignore it. Is that okay? Yes, it is like that. We want to see, it is like we want to see if we benefited from this purchase or not. Yes, you are right. Okay. So guys, you need to calculate bargain purchase gain. If there is a bargain purchase gain, it will increase your investment. It will increase your investment. And on the other hand, it will be recognized in P&L as income. As income. This is your income. This is your gain. It should be recognized as income. So this is how you are going to recognize bargain purchase gain. Now, why we are doing this? This is really important. So listen carefully. Why we are doing this? We should write it at cost, and we just need to pick post tax. We should pick post tax. So why we are doing this? That we are adding actually bargain purchase gain. So we should not do this. So there must be some reason to add bargain purchase gain. So let's understand what is the reason to add bargain purchase gain. What is the reason to add bargain purchase gain? Listen carefully, guys. Look, there is a company. There is a company, guys. Look, this is the company. You are going to acquire this company, but this time you are not acquiring majority holding. You are just acquiring. You are just acquiring. This is a company. So this is a company. So we have a carrying value of, listen carefully, we have carrying value of net assets of this company. Net assets means total assets minus total liabilities of this company. So we have carrying value. Carrying value of net assets are, in this example, 8, just assume. And now we have fair value of these net assets 9. So whenever you acquire companies shareholding, whenever you acquire companies shareholding, you should write net assets of that company at fair value or carrying value. So just give me an answer of this question. If you are acquiring some companies shareholding or net assets, so you should recognize these net assets as fair value or carrying value. Just give me answer of this simple question. Good. The question was whether we should recognize this at carrying value or fair value. At the acquisition date, guys, it means you are acquiring these net assets. If you are acquiring 30% holding of this company, it means you are acquiring net assets of this company. And they are selling, the old owners of this company are selling these net assets. You are buying these net assets. Obviously, they will sell at fair value. They will sell at fair value. So your investment should be recorded at fair value rather than cost. So listen carefully now. So if you have acquired this company, for situation A, I'm making situations. If you have acquired this company for 30% company for 4 million, what will happen? Is there any bargain purchase gain, guys? Just tell me, is there any bargain purchase gain? No bargain purchase gain. Okay. So we need to recognize this at cost. Cost is 4. We need to calculate bargain purchase gain. If there is any bargain purchase gain, we are going to add this. Otherwise, ignore. So how I'm going to calculate bargain purchase gain or goodwill? We have invested 4 million. The net assets fair value is 9, and we have acquired 30% of this 9, and it will be, what would be the value, guys? I think it would be 2.7. So you are paying extra for goodwill, and the goodwill is 1.3. So there is no need to write goodwill again. There is no need to write goodwill again. Why there is no need to write goodwill again? Because in this 4 million, net assets are 2.7 and goodwill is 1.3. It means this goodwill is already a part of this cost. So the cost is actually reflecting pre-acquisition net assets. Pre means pre-net assets. Pre-net assets plus goodwill. So goodwill plus share of pre-net assets will make cost. So it will make cost. So this is cost, guys, 4. So you don't need to recognize it again because it is already a part of 4. But what will happen in situation B? If you have invested just 2 million, then what will happen? If you have cost is 2 million, then you are going to write cost here too. Now you need to check whether we have bargain purchase gain or not. So you will make a working. This data is same for all situations. So now we have share of net assets 2.7. So it means we have a bargain purchase gain. Now listen carefully. So we have bargain purchase gain. Look, your cost is less than the share of net assets, guys. Listen carefully. We are saying that we have acquired net assets of 2.7, but we are just paying 2 million. It means we have a benefit of 0.7. And this value is understated. So if you write this at 2 million, this amount is less than what you got it. What you got is less than, so what you are paying 2 million, which is less than what you got, and you have purchased 2.7 million net assets. So it means you are paying less. If you are paying less, it means you need to increase your liability to get the value that actually belongs to you, because these are the net assets that belongs to you. So you should recognize this investment at 2.7 rather than 2. So we are going to add, and on the other hand, because we have acquired it a little cheap, we have get a benefit. So we need to recognize this in income as well. So what should be the journal entry? It is going to increase my investment. It is going to increase my investment. And on the other hand, it will be recognized as income as gain in P&L. So I'm going to recognize in P&L or in retained earnings. It is the same thing. So this is how we are going to recognize it. I hope this one is clear to everyone now. Now we are moving towards this question. If you are clear, then we would be able to solve this question. So why I picked this question, guys, Lee, before solving this past paper, and the reason was very simple. Whatever you are going to see in your exams, mostly it will be from the past papers. Like we can say that 80 to 85% paper would be from the past papers. So the same concepts would have been discussed in the past papers, and they will be asked again, obviously with a different style, with in a different question, but the things would be there in the past papers. So now what we are going to do, the last one thing that is the condition to recognize bargain purchase gain. If you want to recognize a bargain purchase gain, there is a condition. So what is the condition before recognizing a bargain purchase gain? Condition is very simple. There is a condition to recognize a bargain purchase gain. As per standard, they say if there is a bargain purchase gain, you should doubt. You should doubt your abilities, that we cannot have a bargain purchase gain. How is it possible that someone is selling its company cheap? Someone is selling its company at low prices. There must be some confusion. So what they are saying, that you can't believe yourself when you see that there is a bargain purchase gain. You should doubt this bargain purchase gain. Okay, if I'm going to doubt my abilities, so what should I do? How can I confirm whether it is a whether there is a bargain purchase gain or not? So what they say everything that you used in goodwill calculation, like consideration paid, you need to calculate again consideration paid. You need to assess whether this consideration is at fair value or not. You need to reassess, you need to recalculate, you need to confirm consideration paid again. Then you need to take net assets at acquisition. So you need to again clear that whether these net assets are at fair value or not. You must be missing something. So you need to reassess again net assets fair value. You need to reassess it again. This would be for associate. But in subsidiary, we have one thing extra, which is NCI here. So we can say in subsidiary, we need to confirm 3 items. So they are saying that you need to reset, assess again consideration paid, the net assets fair value, and still after confirming, still you have bargain purchase gain, then you can recognize bargain purchase gain. So if there is any bargain purchase gain, what is the condition? That you need to reassess the fair values used in goodwill or bargain purchase calculation again. And if there are still bargain purchase gain, then you can recognize this bargain purchase gain. Is that okay, guys? If there is a bargain purchase gain, reassess this consideration again. If there is a bargain purchase gain, reassess this net assets again. If still there is a bargain purchase gain, then recognize it. But before recognizing bargain purchase gain, just confirm everything written in goodwill calculation is correct or not. You are taking correct values or not. Is that okay, guys? So now, guys, we are able to solve this part of the question. So let's understand what we are going to solve. So this is question 3. We have solved part 1, and now we are going to solve this part. And the question is very simple. Why this is the joint venture? Why this is the joint venture? You need to write joint venture's characteristics. We have already discussed. So joint venture, separate entity, established, then assets, ownership and liabilities belongs to that separate entity. And joint venture means joint control, and joint control means unanimous decisions, common control. So guys, let's just read this question and then we'll see what's in this question. On 1st Jan 2007, STEM company has contributed cash to the new legal entity. So guys, there is a new legal entity, okay? And STEM company is giving a cash. Emphasize company, the name of that legal entity is Emphasis company, and holds an interest of 40%. The shareholding is 40%. Separate entity is there, and we are holding 40%. The other two companies contributing have retained equity interest of 40 and 20% respectively. It means there are 3 owners. One is STEM, our company. The other two are 40 and 20% respectively. The purpose of the entity is to share risk and rewards in developing a new technology. So we want to develop a new technology and we have make a new entity, and 40% holding is with us, and there are two other owners. And the purpose is very simple, that we want to share the risk and rewards of developing a new technology. The holder of 40% interest can appoint 3 members each to the 7-member board of directors. It means STEM can appoint 3, the other 40% can appoint 3, and there are 7. It means the one can be appointed by 20% holder. All significant decisions require the unanimous consent of board. So what does it mean? Just tell me, what does it mean? So all the parties have board members, and they are saying there must be a unanimous decisions. Unanimous decisions means all the 7 directors have to agree. If one is saying no, this can't be happening, this should not be the decision, this is not a correct decision cannot be taken. So everybody should agree. Yes. So if everybody should agree, what does it mean? So look, there is a unanimous. It means we can say that yes, they have joint control. There is a separate legal entity. If there is a separate legal entity, then we can say these companies are joint venture. Now, the holder of 20% interest can appoint only one board member and can only participate in significant decisions of the entity through the board. There are no related parties. Other than this, they are not related parties. STEM company contributed cash of 150 to emphasize company. So what is our cost, guys? 50%. Sorry, 150. So we should record this at 150. Listen carefully now. We will make a working of investment in associate, but here we will call it investment in joint venture. Investment in joint venture. So what is the cost, guys? What cost is $1,50,000. So we will record our investment at 1,50,000. But what we need to do, there is something extra that we need to calculate at acquisition date, and the extra thing is that we need to calculate bargain purchase gain. We need to calculate bargain purchase gain. If there is any, we need to record that. So this is something that you need to apply always on joint ventures and on associates. So guys, STEM company contributed cash of 150. The entity will use the cash invested in STEM company to gain access to new markets and to develop new products. At 1st Jan X 7, the same day we acquired 40%. The carrying amount of the net assets contributed by the 3 companies was 310, but the fair value of net assets contributed was 470. So what do you think, guys? Do we have any bargain purchase gain? If yes, please give me bargain purchase gain. Please give me bargain purchase gain. One common mistake is you don't apply 40%. One common mistake is you took all the net assets. This is not subsidiary, guys. This is associate or joint venture, and you need to pick only your percentage of net assets. You can't pick the whole net assets, and you can't calculate the goodwill with the complete net assets. Okay. So please give me again goodwill or bargain purchase gain. So just tell me, is there a goodwill or bargain purchase gain? So yes, we have bargain purchase gain. So what is the consideration, guys? What is the consideration paid to acquire 40% holding? So consideration paid is given. We have paid 150,000, and we need net assets. Only our share of net assets there. We should take fair value of net assets, and we have only 40% in that company. So the net assets, total net assets, which are 470,000, we need to multiply this with 40%, and the amount would be 128, 188. Okay, 40% is the shareholding, the percentage of holding. So the 188 net assets. So we have a bargain purchase gain situation, and the amount is, I think this is 38,000. Now we need to recognize this. The examiner asked about the journal entry as well. So you need to make investment in it's joint venture by 38K, and you need to book a gain in P&L of 38K. So this is something that you need to do. So this is bargain purchase gain, 38,000, and you need to recognize it at 188,000. So this is, guys, this is 188,000, sorry. So this is the value or investment value at 1st Jan 2007. So this was the value at 1st Jan 2007, guys. Is that okay, guys? Is that okay? Okay. So this was the question, guys, from September, from the recent attempt that is available on ACCA, in ACCA past papers, on ACCA Global. Now, what is this is entirely a theoretical part. You can solve this. You can read the answer of this part B. Now I'm moving towards the next question that I actually want to solve. This is again an interpretation question. These two questions will give you the exact idea that how the questions on interpretation will be asked. Okay, so again, a good question. So let's understand. If we will have the time, then we can revise sale and lease back transactions. But right now we are moving. Now we are moving towards December 2019 question 4, guys. Very interesting question. The entire question is on interpretation and how a 25 marks question can be set on interpretation. You can see through this question, guys. So we are going to practice this question. Very interesting question. So let's understand what was the part A of this question. So let's understand, guys. Part A was very simple. But let's understand what was the part. Discuss the reasons why an entity may choose a particular accounting policy, where an international financial reporting standard allows an accounting policy choice. And so there is a second requirement. So and means this is the second requirement. So guys, and means there is a second requirement. So first requirement is discuss the reasons why an entity may choose a particular accounting policy whenever there is a choice. And second requirement is whether faithful representation and comparability are affected by such choices. So accounting policies, there are a lot of standards which provide choices to the accountants, to the company, and the standards are, few standards are, guys, IS 16. IS 16 allow you to follow cost model or revaluation. Entity can choose a model between cost model and fair value revaluation model. Then we have IS 40. IS 40 again give you two models, two methods of accounting. Models means methods. The one is cost model and the other one is fair value. The same choice is available in IS 38. So I-38 and I-16 provide two choices. Then others choices in which these options are available are IS-20. When we have government grant related to assets, government grants related to assets, then again we have a choice. We can present those grants as a reduction in asset, or we can deduct, we can treat it as a deferred income as a liability. So these are the choices available. So there are situations where choices are available and entity has to choose between the choices. So they are asking how. Discuss the reasons why an entity may choose a particular accounting policy. Why an entity may choose to follow cost model rather than revaluation model, or why some entities will choose revaluation model in the same way in IS 14, the same way in IS 20. Why? So actually, you need to give the reasons why they will do that, how they are doing that. So you need to tell them how and why they are doing this. Okay. The second requirement is whether the faithful representation and comparability are affected by choices. Obviously, if some companies are following cost model and some companies are following a revaluation model, obviously their financials would not be comparable. There would be a problem. At the end of users, when the users will watch both companies' financials, their profits, the net assets, liabilities, profitability will be entirely different under both methods. So yes, comparability will be compromised by giving these choices. Yes, faithful representation can be compromised. How? Entities will not choose a revaluation model if revaluation model is affecting the ratios, is affecting key performance indicators in a negative way. Look, if I'm following revaluation model, my profitability will decrease because the revaluation gain assets have increased and the depreciation would be more than under cost model, would be more than the cost model. Then obviously I'm not going to follow the revaluation model because the depreciation will be higher. Then in revaluation gain, we have to recognize the gains, and the gains will increase my equity, and the return on equity will decrease. Return on equity will automatically decrease. So obviously the company will feel at some times that although revaluation model is a better model or cost model is a better model, but we can't follow the revaluation model because it will impact our ratios and the performance of our the management will look bad. So they will not follow. So yes, faithful representation can be compromised. Yes, by these choices. Then why we are giving these choices to different in different standards? The reason is very simple, because the nature of entities are different. There are certain situations where the nature of entities are different. So if the natures are different, for some entities the cost model is an appropriate model. For some entities, fair value model is an appropriate model. So the nature is different. How the nature is different, sir? How can you prove that the nature is different? It is very simple. Look, just take an example of investment property because he's talking about the investment property in this scenario. Okay. So listen carefully. Now, look, IS 40, you have lots of properties, guys. Properties for rental purpose to other. If you have a properties or property for rental to others, it is a property of IS 40. We call it investment property for rental to others. And the complete definition is property for rental to others or property for capital appreciation. Property for capital appreciation means property for capital appreciation. Property for capital appreciation means you have acquired the property to get the gains through the market value fluctuation. You want to increase the value of the market value of the land, and you will get the benefit. You will sell at certain point and you get the increase. So guys, this is the definition: property acquired for rental to others or property acquired for capital appreciation. Now guys, there are two types of entities. The first entity is who have acquired the properties and they are managing it. They are doing business of rent. They are just earning a rental income. They're just earning a rental income. That's it. Are they interested in gains? Obviously, they feel happy when there is a gain, but they don't have any intention to get the gains. They don't have any intentions to sell the property. They are just managing the property to get the rental income. So if they are managing the property to get the rental income, the appropriate model here would be cost model, because the company is not interested in the market value of these properties. They are managing to earn the rental. It means the cost model is an appropriate model, because under cost model, there would be no gain loss, there would be no fair value, and obviously the rental income will be charged to P&L, and on the other hand, depreciation will also be charged to P&L. But if someone is managing the properties for capital appreciation, and we know there are two different types of property dealers or the property real estate companies who are managing in two different ways. Someone is managing to earn properties, someone is actually trying to earn from the market fluctuation. The best example is who are managing properties to earn rentals. All the malls, guys. If some company has built a mall, like in Dubai, we have a Dubai mall. Okay, so Dubai mall is owned by some company, and that company, what the company is doing, they are just giving their property on rent. That's it. They are earning rentals. They are not going to earn from the capital appreciation. They are managing that mall to earn rentals. That's it. So now the appropriate model here is not a fair value model, because they are not interested in the fair value fluctuation. So the appropriate accounting here would be the cost model rather than fair value model. So that's why the choices are given in the standards. So choices are given because the nature of entities are different. Sometimes they are managing different in a different perspective. So the choices should be there to do the faithful representation. So now how and why an accounting policy could be chosen? Obviously, they will the management will check the impact on different ratios, different financial ratios, different key performance indicators, KPIs. They will check the impact. They will check the needs of the users. They will check the which model actually is reflecting the basic model of business, which model is appropriate, which method of accounting is appropriate to describe the nature of, according to the nature of entities, which is more relevant, which is actually, which one is the more reliable, which one is the more relevant, which one is showing a faithful representation to the users that what we are doing. So they will pick the policy according to these factors. Is that okay, guys? Now I have to give a little introduction to these cost and fair value models, specifically in IS 40. So listen carefully, guys. In IS 16, in IS 16, we have two models. One is cost model Under cost model, we are going to recognize an asset at cost, initial cost, purchase price, less we are going to deduct accumulated depreciations. It means we are going to depreciate. And if there is any impairment loss, we are going to deduct accumulated impairment loss. This is accumulated impairment loss. And we calculate this impairment loss as per IAS 36. This is cost model, guys. Same cost model is applicable in IAS 40. It means in IAS 40, you charge depreciation on property under cost model. If you are following cost model, then you will be doing this. So this is same in IAS 40 as well as in IAS 16. Now, what is next? The next one is in IAS 16, revaluation model. Guys, under revaluation model, you write the assets at fair value. Now, just tell me which standard will help you to get this fair value, which standard is going to help you to calculate this fair value. Then, guys, you are going to deduct the subsequent depreciation, subsequent accumulated depreciation, accumulated depreciation. It means you are actually charging depreciation. You are not stopping the depreciation, and then you have if there is any subsequently after revaluation, subsequently means if there is any impairment loss or depreciation after revaluation, then you are going to write this as well. So this is revaluation model. Now under revaluation model, under revaluation model, under revaluation model, gain will be charged to other comprehensive income. Under revaluation model, guys, revaluation gain, if the market value is greater than carrying value, is more than carrying value, we will have revaluation gain. It will be charged to other comprehensive income, and it will not be recycled to P&L. It will not be recycled to P&L. And then if we have revaluation loss, it will be charged to P&L. But yes, what we do, we usually offset these gains and losses, offset gain losses of same asset. This is again an important thing of same asset. Same asset means if we have a gain on one land, land one, and we have loss of land two. So these gains and losses cannot be offset because the land one is a different asset, land two is a different asset. But yes, if we have gain on land one, then after some time we have a loss on land one, then we can offset. So same assets, gains and losses can be offset. I'm not saying same class. If I would say a same class, then it means I'm saying land one gain can be offset against land two. No, this can't be this can't happen. This can't be the case that you can offset the gain of one land, one building to the other land and to the other building. On the other hand, guys, in IAS 40, this is again in IAS 40 we have fair value model. We have fair value model, and under fair value model, you recognize asset at fair value. That's it. No depreciation, no impairment, no depreciation, no impairment, and most importantly, gains and losses will be charged to P&L. Any gain, any loss, P&L. No OCI, it will be charged to P&L. So this is fair value model. So someone asked me what is the difference between revaluation model and fair value model. You can check what is the difference between fair value and revaluation model. I hope everyone is clear now. Now let's move towards the next part of the question, which is again an interpretation. This is also an interpretation question, that how the comparability of two companies actually affected by choice of accounting policies. Now we are moving towards this part. Is it visible to you guys? Please do let me know. Okay, guys, just wait for few minutes. So just wait. Okay, guys, please do let me know. Is it visible now? Okay, guys, it is again a good question, guys. Okay, Nazis, you can manage. Otherwise, if you have past papers with you, you can open December 2019 question 4. Okay. Thank you so much. Okay, guys. Now, let's understand. The question is very important if you want to learn the analysis, interpretation questions, analysis questions. So listen carefully what is the requirement, guys. So requirement is discuss the discuss the usefulness to investors of return on equity ratio. So they are just saying that what is the benefit of return on equity ratio? What is this return on equity ratio? Just wait, okay? And its component parts. I don't know what are its component parts, honestly speaking. Okay. Provided above. So he's actually saying that I have provided this above. So don't worry. If you don't know what are the component parts, I have provided above. So he's just saying that discuss the usefulness to investors of the return on equity ratio and its component parts provided above. It means you need to just explain what does this ratio means, what is the information that this ratio will give to the investors, that's it. And obviously it has some component parts which are given above. You need to talk about those ratios as well. Look, so I came here to the question. Look, guidance companies considering the financial results for year ended 31st December X6, the industry places great reliance on the return on equity as an indicator of how well the company uses shareholders' fund to generate a profit. So look, actually, why it is important, it is already given in the question. You can write this line. You can write this line, guys. So this is why return on equity is important. Why this is important? Because it provides, because it provides, because it provides how well, it is an indicator of how well the company is using shareholders' funds to generate profits. Now, return on equity. Guidance company analysis return on equity in order to understand the fundamental drivers of value creation in the company. Return on equity is calculated as. So he's giving you a formula, guys. Return on equity is the ratio. Its components are, one component is this ratio, second component is this ratio, and the third component is this ratio. If you will see what would be the final result of this ratio, then you will find that these assets and these assets will cancel out each other. These sales and sales will cancel out each other. And the final formula would be net profit, means profit before tax, divided by equity. So this is the formula of return on equity. But the first part is very simple part. You just need to explain what is the meaning of return on equity, what is the message that this ratio gives to the investors. In the same way, net profit before tax divided by sales, we know this is the net profit percentage. What is the message through given through this ratio? Then this is asset turnover ratio. We call it usually asset turnover ratio. So asset turnover ratio, and that this is asset to equity ratio. What does it mean? Obviously, I'm going to explain. Is that okay, guys? Are we clear? What is the first part of the first requirement, guys? Always divide requirements into subparts. This is first requirement. I'm going to solve this and calculate. Very easy 5 marks, and calculate these ratios for the year ended 31st December X5 and X6. These calculations should be based on the information provided in table 1. Where is table 1? Where is table 1? So here is the table 1. So this is table 1. Where is table 1, sir? So where is table 1, sir? Here is the table 1, sir. This is table 1. This is table 1. So simply you need to calculate these ratios 1, 2, and 3. These ratios, and obviously return on equity for 2000x5 and 2000x6. Very simple, no problem at all. So I just want you guys to calculate x5 and x6 ratios quickly. Calculate this ratio, this, and obviously then return on equity by multiplying all the ratios, or you can follow the formula for return on equity, PBT, profit before tax, and divided by capital employed. Sorry, equity, divided by equity. Look, this is return on equity. So just calculate these ratios, guys. I am looking for your answers. Someone is saying that my voice is not clear. Please do let me know. Are you listening me clearly? So is it clear? Okay. Thank you, everyone. Thank you so much. Okay. Now, guys, just calculate some ratios. Okay, let me calculate these ratios, then we will explain this. Okay. For 2000x5 and 2000x6. So net profit percentage would be 300 divided by 200. It will give me 15%. Then sales to assets ratio. Then what we need to do is sales divided by assets. It will give me sales divided by assets, guys. What would be the answer, guys? Point 0.8. Thank you so much. So this is 0.8. And then we have assets divided by equity. And it will give, obviously 0.8 means 80%. Yes, you are right. 0.8 means 80%. 250 divided by 175 will give us 1.43. Thank you so much. This is in the same way we need to calculate the next year's, guys, as well. Okay. I hope you can calculate the next year's as well. There is no analysis required. So that's it. This is for this is for 5 marks, guys. So interestingly, this was for 5 marks. Now, what we need to do, listen carefully. So what is next now? So in the same way, you will calculate this year as well. So I hope you can calculate it. Do I need to calculate this, guys, for 2006 as well? Yeah, it's okay. Or it's okay. Okay, thank you so much. Now, what does net profit over sales reflect, guys? What does it reflect? It reflects, if this is 15%, it means how much profit a company is making for every 100 sales. How much profit entity makes for every $100 sales. For every $100 sales. Is that okay, guys? You can write this ratio in other words as, like, the other wording can be used for these ratios. Like, you can say how much sales is being converted into net profits. What does it mean? If your sales is 100, your cost of sale is 20, then it means your sale 80 out of your sale has been converted into GP. Then we have expenses of 35, and then the profit would be 45. So you can say that out of 100 we have earned 45. So 45 sales out of 100 sales, 45 is being earned by the company. How many sales has been converted into profit figure? So that's it. Sales to assets ratio will reflect how the assets are being utilized, to generate sales, how assets are being used to generate sales, You can say that how assets are being used to generate sales. In other words, you can say that how efficiently assets are being used to generate sales. How efficiently? If obviously if ratio is increasing, then it means we are efficiently using assets to generate our sales. If it is decreasing over the years, then obviously it would be a problem. Then, guys, assets to equity means how much assets are being financed from equity. So if we have here 1.43, we have assets and we have liability. We have equity. So assets to equity. It means if we have $1.43 assets, then obviously one is actually being financed from equity. So how many assets are being financed from equity? This ratio will explain us this point. And obviously the other one, like 0.43 here, will be financed from the debt. So how many assets are being financed? So you need to write these things in your own words and you'll get easily these marks. So this was for 5 marks, guys. Very easy 5 marks, but now there are 12 marks available and 2 professional marks are available. So now you need to solve 12 marks part in the last 15 minutes. So listen carefully, guys, what is happening now. Listen, and we need to solve the questions very carefully. So I'm going to read this information for you guys. So I have to zoom in because this is important. So listen carefully now. Second requirement, guys. What is second requirement? Please listen carefully. Discuss the impact that the setting up of SPE, special purpose entity, and miscellaneous transactions. So these are the headings that he has already used in company in the question. SPE and miscellaneous transaction. You can see, look, here is a special purpose entity for SPE, and the other one is miscellaneous transactions. Okay. So these are the two headings that they have already used in the question. So if something is very different, some wording is very unique, then you can see in the it will be mentioned in the question. How the SPE and miscellaneous transactions have had on return on equity and its component parts. So you have to tell the impact of setting up the SPE and miscellaneous transactions have had on return on equity and its component part. Given these considerations, adjust table 1. So they are saying adjust table 1. Due to these two transactions, adjust table 1. What is table 1, guys? This is table 1. This is table 1. 2000x5 values, 2000x6 values. So we have 2005 and 6 values. Now, adjust table 1 and recalculate the return on equity for 2000x6, thereby making it more comparable to the return on equity for 2000x5. What does it mean, guys? I just want you guys to understand this, making it more comparable to return on equity for 2000x5. Guys, you have entered into a two transaction. The first one is SP and the other one is miscellaneous transaction in 2006. Just tell me, if you are doing these two transactions in 2000x6, would your ratios will be comparable to 2000x5? If you are doing some transactions, some major transactions in 2000x6, and those transactions were not present in 2000x5, so can we say that these two years are now comparable? We can't say this. Why we can't say this? Because there are certain major transactions happening in 2000x6 which were not present in 2000x5. So these new transactions make ratios difficult to compare. So what do we need to do? So just give me answer. What should we do? What should we do? So he's saying adjust table 1 and recalculate. So what we need to do to make it more comparable, we will reverse the transactions. We will reverse special purpose entity transaction. We will reverse miscellaneous transactions. If we will reverse the special purpose entity and we will reverse the miscellaneous transactions, then obviously both of these companies will be comparable to each other, because these transactions have been eliminated from 2000x6 as well. Is that okay, guys? That we need to reverse these transactions to make it more comparable? Please tell me. Okay, thank you so much. Now, guys, what we need to do? So now we need to reverse. How to reverse and how to adjust table 1? This is the basic thing. So do we need to adjust for both years? No. These are the transactions that are happening in 2006. So obviously you need to reverse in 2006 only. Okay. Now let's see what is happening now. Listen carefully. Special purpose entity. What is special purpose entity? Let me zoom in, guys. The transaction, because some of our friends was having a problem. Okay, this is special purpose entity. So listen carefully, guys. During the year ended 31st December 2006, so this is the problem in 2006 only. Guidance company stated that it had reorganized its assets. It had reorganized its assets and set up a special purpose entity. Guidance company transferred property to special purpose entity at its carrying amount of 50 million. The carrying value of property was 50, but had incorrectly, he's saying it is a correct, it is an error. So we have to correct this error, but had incorrectly charged revaluation surplus reserve with this amount rather than showing the transfer as an investment in SP. So just please give me what is the actual error here. So actually, if you are investing in, you have made another company, okay, fine, you can do that. You have picked your investment property, you transferred it to your special purpose entity, the company you have just set up. You have transferred. It means your investment property is decreasing. Your investment property is decreasing, but on the other hand, your investment in that new entity, investment in SPE is increasing. So what should be the journal entry? What should be the recording? Recording should be that you should record this as investment in SPE. And he's actually giving you the guidance. So it should be recorded, look, it should be recorded as investment in SPE. And he's saying that it has been charged to revaluation reserve. It means we have, what we have done, we have, guys, what we have done, so we should do investment in SPE debit, and we should credit investment property. So our investment property is decreasing. We have transferred it to SPE. SPE means special purpose entity. So it is decreasing. So we should decrease this by 50, and we should increase investment in SPE. So one asset is decreasing, the other asset is increasing. But what they have done, this is the correct treatment. But what they have done is they have debit it with investment in SPE by, no, they didn't debit, they didn't charge, they did charge it to revaluation reserve. So they charged it to revaluation reserve and they credited investment property. So what is the rectifying entry, guys? What should we do? Just tell me, what should we do? What should we do? This is the correct accounting treatment. This was the wrong that they have already done. Now, what should we do to rectify this error? Please tell me, what should we do to rectify this error? Yes, we should credit this. The first thing that we should credit is we should credit this SP, this reserve. Yes, you are right. And this revaluation reserve is an equity. This is the part of equity. So it means our equity will increase. It means our equity will increase, guys. So our equity will increase in 2006. So I need to increase this by 50. Low. On the other hand, so I have credited this. Credit will increase equity, and I have to debit investment in SP. It means I need to increase my assets. So this will increase my assets. So it will increase my assets. Is that okay, guys? You can write the other stuff as well. We need to correct the error to make it more comparable. Otherwise, you can say, yes, it is basically investment in SP. So the correct entry was the rectifying entry. I should write as well. So, okay, we should debit investment in SPE and we should credit revaluation surplus. Revaluation surplus, revaluation reserve. So this is the journal entry, guys. Our one asset is increasing and our equity is also increasing. Now, guys, now you can say that we need to, and the most important thing, if there is any special purpose entity, you have to consolidate this because you are controlling this. This special purpose entity is under your control, so you have to consolidate it. So in other words, you can say that the investment property will be there in consolidated books, okay? It means we will consider that this is not a transaction at all. Now, let's see what are the miscellaneous transactions and what we need to do here. So guys, important transaction. So please listen carefully. Now, the first transaction is guidance company. Let me zoom in. Okay, boy. Look. So the guidance company has bought back 25 million shares. They have bought back 25 million shares. So they have bought back 25 million shares of $1, which is par value, at 1.2 per share during the year ended 31st December 2006 for cash and cancel the shares. The transaction was deemed to be legal. So this is a legal transaction, but they have done a transaction and we are eliminating them. So what we need to do, guys, what should we do? Just let me know what should we do. We should calculate how much we have paid for this. We have paid 25 into 1.2. So what was the entry? And now what we need to do, listen carefully. So what they did, they have passed entry, they have bought back their own shares. So it means they have debit equity and credit is cash. So one asset is decreasing and the equity is also decreasing. So I need to reverse this transaction to make it more comparable with 2000x5. So what I need to do, this entry was with for 30. Now I need to reverse. So guys, reverse this transaction. You need to debit cash. So it means our assets will increase. Our assets will increase. On the other hand, our equity will also increase. So we need to increase the equity as well. Someone call it, someone call it treasury shares as well. Okay. But here they didn't call it treasury shares. The reason is they cancelled the share. If this shares has been cancelled, then then we can't call it treasury shares. Now, guys, what is next transaction? The next transaction is, again, I have to zoom in. The next transaction is guidance company also raised loan capital for the first time during the year ended 31st December 2006 for 20 million in order to help with the buyback of the company shares. So guys, when we have acquired loan, debit would be cash and credit would be liability. What would be the journal entry that are, if we are acquiring loan, the cash will increase and the liability will also increase. So the net effect on equity will be zero. Net effect on equity will be zero. So what is the difference between, so the net effect on equity will be zero. So we don't need to adjust this transaction because it will not affect our ratio. The next is guidance company has purchased 25% interest in an associate company on 1st July 2006 for cash. So they have acquired an associate for cash, guys, 25% associate. The investment had cost 15 million and an associate had made 32 million millions in the year ended 31st December x6. So guys, how many months? Only 6 months ago we have acquired. So we need to take only post-tax profit. This is the profit for the year. We acquired on 1st July 2006. The guidance company accounted for the purchase of associate correctly. So they have treated it correctly, but we need to reverse. So what they have done, we need to adjust. So I'm going to make a journal entries here. So let's see what is the, look. So what they have done, they have made an investment in associate. So if they have bought it for, they have bought 25% shares for 15 million, it means they have recognized an investment in associate by 15 million. Then the company earned 32 million for the year, but we need only the post acquisition profits is only for 6 months. And we need to pick 25% of this. What is the value, guys? Please do let me know what is the value. It is 4. Yes, thank you so much. Now just let me make the journal entries. Debit is investment in associate for this 15. 15 will increase my asset. On the other hand, this will decrease my other asset. So what is the net effect on assets? Guys, one asset is increasing, one asset is decreasing. So what is the net effect on assets? Nil. So it means we don't need to count the effect of this. assets will remain same, everything will remain same. What is the journal entry to record this for? It will increase your asset investment in associate, and you need to book a profit in P&L, sometimes in consolidated retained earnings, sometimes in retained earnings. So it means this 4 has increased your assets. So we need to decrease our assets now, and it has increased your equity. It has increased your retained earnings profit. So we need to decrease this from here as well. So guys, now we have revised everything revised. Okay, sorry. This 4 should also be added to the net profit because it has already been added to the net profit. So it should be decreased from here as well. So it should be decreased from 4 from here as well. Is that okay, guys? Now, guys, we have revised balances of everything. Like we have 38 plus 4, 38 minus 4, it will give you 34. Then we have assets. What is the impact on assets, guys? Obviously, you can calculate these assets and equity, and then you can recalculate these ratios. And after recalculating, you can say that which ratio is increasing and which ratio is decreasing, because he has asked you the impact of setting up this special purpose entity and miscellaneous transaction. Is that okay to everyone, guys? Okay, thank you so much, guys. So the last question is, what is SPE? Guys, usually what entities do, they make new entity to do some operations, to do some task, to do some operation, to do some project. And when they make a new entity, they transfer their assets to this entity. And this entity is set up for a very short period of time. It has specific task to perform. And when the task will complete, when the project will complete, this company will be dissolved. So we usually call it special purpose entities. Now, in special purpose entities, if one company has made a special purpose entity, if only one entity has made special purpose entity, this special purpose entity will be a subsidiary. If two entities, suppose A and B had made, if two entities had made a special entity, then what will we do? We will say that if they have unanimous, they are taking unanimous decisions, they have common control, we will say the special purpose entity will be a joint venture. In the same way, if we have made a special purpose entity, but we have just only significant influence over that, then that special purpose entity could be associate. So it could be anything, but in majority situations, this would be the situation, guys. That special purpose entity would be your subsidiary. I hope everyone is clear. Thank you so much, everyone. That's it for today. If you have any question, then you can ask in WhatsApp group. Stay blessed. Allah Hafiz.